Welcome back to Alpha Found. The last video ended with three possibilities that could explain why positive alpha is associated with low CAPM beta. They are: CAPM is flawed, or the estimation methods for alpha and CAPM beta are flawed, or markets are not efficient, or some combination of these three. To look at this further, let's look first at alternative models. There are two types of models that serve as alternatives to CAPM, but in some way are derivative of CAPM. They are multi-moment models and multifactor models. MPT uses expected mean returns and the covariance between securities. CAPM uses mean returns and the covariance with the market. Mean return is called the first moment, variance is the second moment. Purists would call variance the second central moment. The third and fourth central moments do not show up in MPT and CAPM. The third central moment is skewness, which means the degree to which data is distributed asymmetrically, including outsized return to the upside or downside. The hope for outsized returns, or lack thereof, might alter what investors are willing to pay for an asset. It is doubtful that most investors know what skewness is in a formal sense, and much more doubtful that they have a working knowledge of how it operates in the context of portfolio construction. From before the beginning of formal asset pricing theory, skewness was observed in price dynamics. The fourth central moment is kurtosis, which means fat tails or long tails of a statistical distribution. Is it possible that investors are consciously or unconsciously considering higher moments when they make investment choices, including choices concerning diversification? The book The Random Character of Stock Market Prices discusses skewness, yet when formal theory was developed, higher moments were ignored. Easier problems had to be solved before more difficult problems could be tackled. Higher moment optimization was thought to be intractable. No one believes that stock returns are normally distributed, but the normal distribution is so easy to work with that it's assumed to be good enough for a lot of modeling purposes. Only two moments are needed to describe completely the normal distribution: mean and variance. If a greater sophistication than the normal distribution is desired, the next distribution of choice after the normal is the log normal. It has a better intuition to it, and it has well-defined skewness. However, it is much harder to work with in many applications. Also, like the normal, the log normal ultimately doesn't work as well as we would like. If the level of sophistication is upped again, some, like Benoit Mandelbrot, favor the stable family of distributions, which has certain advantages but also has some absurdities when applied to investing, like infinite variance. It should be noted that the normal distribution is the only distribution in the stable family that has a finite variance. It is a conundrum as to what probability distribution applies. I will have a thought about this in the 28th video. We haven't discussed the formula for CAPM beta yet, so let me do that now. In the CAPM OLS case, estimated beta is equal to the covariance between an asset and the market divided by the variance of the market, which equals the correlation between an asset and the market multiplied by the standard deviation of asset returns divided by the standard deviation of market returns. But this is a two-moment model. Even if the mathematics of multi-moment pricing models had been worked out in the early days, the estimates needed to run the optimization are significant. Just as MPT could be simplified to a single-factor model called CAPM, there is a single-factor simplification of the multi-moment model. It introduces an additional parameter called constant proportional risk aversion. In some multi-moment models, estimated beta equals the covariance between the asset and the negative of the market to the negative b power divided by the covariance between the market and the negative of the market to the negative b power, where b is the constant proportional risk aversion. The formula does not have much intuition to it. Under certain conditions, constant proportional risk aversion, b, can equal 1. With that simplifying assumption, we get equation 6.3. One view of multi-moment models is that investors are pricing more moments than modern portfolio theory or CAPM. The differences between the two moments of MPT and multi-moment models result in a positive alpha for low CAPM beta stocks because MPT is not considering all information important to investors such as skew and kurtosis. Once the higher moments are considered, then alpha disappears, or it's supposed to disappear. A different interpretation is that the pursuit of higher moments by investors, who can be risk-seeking rather than risk-averse, causes the prices of higher CAPM beta assets to be pushed up. This causes higher CAPM beta stocks to be overpriced and lower CAPM beta stocks to be underpriced, which over time means negative alpha for high CAPM beta stocks and positive alpha for low CAPM beta stocks. While I believe there is something to this reasoning, it's not enough to explain the persistence of the volatility effect, and it's not specific. That is, specifically, how much risk-seeking results in how much higher or lower alpha. Meanwhile, there are a lot of smart people in Wall Street who know how to take advantage of pricing anomalies. Yet the volatility effect, which for our purposes has not been defined yet, persists long after it has been documented. In my view, the multi-moment models contribute some insight, but don't solve anything the way we would like to see. There is a book that offers a development and discussion of multi-moment models. It's not for the mathematically faint of heart, but it's easily found in a PDF download. Multi-moment asset allocation and pricing models.